Good day, everyone. Uh, we are here to present our topic, which is identifying the price volatility of Forex through linear regression and clustering. And I'm Denzel John Simsuangco, and here I am with my group mates Jasper, Peregrino, Alvin, Jhone, Andrei, Paolo, and Miguel, and Alvin Talavera. And I'm here to present the background of the study. So here are the outline of the topics. The foreign exchange market is a global system of trading currencies. So this is a place where different kinds of money can be exchanged for different currencies, like converting US dollars to pesos and furthermore other denominations as well. So the forex also covers different aspects of trading. So there is also existing buying, selling, and converting of currency. So you can sell the money, or you can buy a different kind of money as well. So the importance of identifying the volatility of forex is to know if the trading of currencies is beneficial towards those who are frequently in the market of trading. So if you are in the market for forex oftenly, you would want to know if whether you are gaining money or losing money in the process. So it is possible to have both ways. So when you exchange your money to, let's say, pesos to dollars, it can be at a higher rate or at a lower rate. So by identifying the volatility, you can identify uh, which instance will be occurring when you convert your money. So the next is trading through forex can become profitable as long as the market that you are trading in has a good exchange rate. As I said before, it can either make you lose money or gain money. So by making you gain money, so if you trade well through forex, you can exchange your money and gain money at the same time. So when you exchange money and you sell the money that you exchanged, you can gain a higher profit by having higher rates during the exchange. So identifying the changes in the foreign exchange market can become beneficial, especially for those who plan to work abroad. So if the market is good in trading the money, so when you work abroad, of course, you will be gaining different kinds of money. So aside from pesos, like dollars, Canadian dollars, Hong Kong dollar, won, yen, all those other kinds of money. So when you earn those kinds of money and you convert them to pesos, if it has a good exchange rate, you will be earning more than you can earn here in the Philippines. So all in all, that is a good benefit. So the volatility of the foreign exchange market will be responsible to find out whether or not it will be worth to trade currencies. So as I stated before, it can make you either lose or gain money. So by identifying the volatility, which is the risk factor of exchanging money, you will know whether or not it will be safe to trade currencies or just stick to the kind of money you want to keep. So if you want to exchange the pesos into dollars, and if the market is not good, you would want to keep your pesos instead. So Forex covers all the known denominations and variation of prices exist depending on said currency. So not all exchange rates are equal. Like when you convert your pesos to yen and then yen to dollars, there will be slight differences in exchanging of the money. So you have to be really careful whenever you trade your currencies to, because there is always the risk of either losing money, or even gaining money, depending on the exchange rate. I am Denzel John Simsuangco, and thank you.
The Forex market is a marketplace for trading currencies. Investing in the foreign exchange market involves risk. The volatility of a currency refers to how much its price changes in a short period. Market volatility may appear difficult to understand and forecast due to its reliance on seemingly random but interdependent variables. With the current state of our exchange market, it is difficult to predict the best time to buy a currency pair at any given point in time.
I'm Andrei, Paolo, and Miguel, and I will discuss the methodology of the identifying the price volatility of Forex through linear regression and clustering. In this study, the researchers used clustering and linear regression in order to check the volatility of Forex from a 15-minute time frame price changes in 2015. The goal is to is to figure out how to spot pricing patterns without relying on human mind's guess. Linear regression is a strategy that may be profitable for investors and is available in most charting softwares.
Linear regression. A linear regression is a statistical model that analyzes the relationship between a response variable and one or more variables and their interactions. Linear regression is among the most fundamental statistical models available, with findings that can be understood by virtually anybody and a history dating back to the 19th century. This is one of the reasons why linear regression is so useful.
In this slide, we can see the pseudocode for linear regression. Here is the input for the our program, the mydata.lm. For the output, we will use summary. For the plot, you can see in the next slide what is the cluster data looks like. So what are the advantages of linear regression? The most significant benefit of linear regression is linearity. It simplifies the estimating process. It has more likely predictions than any other regressions, and these linear equations have a simple and convenient modular meaning. It also has good indicator of volatility. Traders can plan their target prices and losses with regression.
K-means clustering. K-means clustering is a method of vector quantization originally from signal processing that aims to partition end observations into K-clusters.
Clustering in R is a fundamental approach that divides the data set into various groups that are also known as clusters. Based on their similarity, following data segmentation, multiple clusters of data are created. A cluster's items all have similar properties. Clustering is used to locate comparable data sets through data analysis. So this is the pseudocode for clustering. For the input, for the output, we will use summary. And for the plot, we will use ggplot. This is the clustered data. So what are the advantages of clustering? Clustering is substantially more efficient when the numbers of variables is huge. It is simple to construct and needs less time than other algorithms. In K-means technique, the proper centroid is obtained by iteration. Lastly, the traditional hierarchical clustering algorithms yield fewer clusters than K-means. So, what are the importance of highs and lows of Forex volatility in linear regression and clustering? First one is the disparity between the high and low values of a price in a pair is known as volatility. Distinguishing the price difference in a specific time frame is capable with figures of highs and lows. It refers to the fluctuation in trade prices. The higher the figure, the more volatile the market is. On the other hand, the smaller the number, the lesser the risk and the volatility. It measures how much a currency has fluctuated in a given period of time. Lastly, it will graph or plot the cluster data and it will show where the consistent price is in the market.
Hello, I am Calvin Ong, and I am here to report the results that came up with our Hello, I'm Calvin Ong, and I'm here to report the results using linear regression and K-mean clustering. So first is the result in linear regression. So two sets of data were used to determine the volatility of Forex, where the first set of data uses the values open and close, while the other set of data uses the values high and low. Using the open and close values, It determines if the forex has strong or weak momentum. Momentum determines the stability of the price and how much income can one gain. Observing the graph, the values are close to the regression line or the middle, and the values of open and close, which are 1.092 for open and 1.098 for close, are adjacent to each other. This shows weak momentum as the values are close together, thus establishing that Forex has stable prices in that region. However, stable prices are not always good news, as weak momentum may also mean low income, as there is a little to no change in the price trend of the trade. Using the high and low values, it determines the volatility of Forex. Volatility determines the speed of change in price. With that, it determines the risk of trade. Higher volatility, the riskier the trading is. As shown in the graph, it has the same results with the values of open and close, where the values of high and low are also close to the regression line, with the values of 1.085 for low and 1.095 for high, which are also close to each other. This shows a result where Forex is low volatile, thus the risk of investment is low. Lastly is the result using K-mean clustering. In K-mean clustering, only the open and close data were used to determine the stability of prices in Forex. As the open and close data were clustered, three groups are identified wherein the prices have the potential to go high or low. As observed on the graph, among the three groups, the middle part is where the price is more consistent and where the cluster stays in the middle. Changes may still occur in Forex, however, Forex will still remain stable.
Discussion and conclusions. Based on the results from the linear regression program, the first set of data consisting of open and closed values, and the second set of data consisting of high and low values. The closed data values represent the Forex values that are stable during a period of time. The high and low values represents the volatility of Forex. Based on the results from the K-means clustering, as observed on the graph, among the three groups, the middle part is where the price is more consistent and where the cluster stays. This is the values that represent the stable Forex values during that time. In conclusion, Forex values can change dramatically in any period of time. Everything that involves here includes the risk factor with your money. It is up to you to know how to handle your money and take the risk.